Welcome back to your XRP Daily Brief, where the goal is simple. Walk through everything that could push XRP's price dramatically higher, using clear logic, real mechanics, and the bigger picture that most people ignore. Today is about going deeper than headlines and hopium. We're going to look at dark pools and OTC desks, Ripple's position, ETF flows, potential bank-level integration, supply compression, regulatory shifts, and how all of these threads can weave together into a scenario where XRP simply cannot stay where it is today. By the end of this, you'll understand why demand can explode even while the chart looks sleepy, and why many large holders are in no rush to part with their tokens at low prices. Let's start with a common question that came up after a recent discussion on dark pools. Someone asked whether these hidden venues could just run forever, matching giant buys and sells without ever letting the price move on public exchanges. On the surface, that sounds logical, but it misses one crucial point. There is no infinite secret stash of XRP behind the curtain. Yes, there are big players who prefer executing size in dark pools and over-the-counter deals so they don't move the visible order books. But those sellers are not bottomless. As real utility grows, as regulation clarifies, and as expectations for XRP's future increase, the people and institutions that hold large stacks naturally become more reluctant to sell cheaply. Over time, the easy supply that can quietly fill enormous orders starts to thin out. When that happens, those buyers eventually have to step onto public exchanges. That is where you get sharp, sudden moves that look completely disconnected from what price action looked like in the weeks or months before. Now consider what happens when this shift meets a market where retail only holds somewhere in the range of 1 to 2 billion XRP. That may sound like a big number, but in the context of institutional demand from spot ETFs, futures products, banks, corporates, index funds, and payment platforms, it is nowhere near enough. If dark pools and OTC desks can no longer fill every order using off-screen inventory, that demand spills onto exchanges. Order books that once looked stable can get eaten in minutes, and price has no choice but to move to levels where long-term holders finally feel like selling makes sense. Many of the most committed people in the XRP community talk openly about not even considering a sale unless they see 3 or even 4 digits per coin. That mindset does not guarantee outcomes, but it absolutely matters for how quickly liquidity disappears when big money starts buying in size. There is another angle that often gets overlooked in these dark pool discussions: Ripple itself. Some argue that once OTC desks exhaust supply, buyers must rush to open exchanges. In reality, there is a much more flexible path. Ripple can distribute XRP through its on-demand liquidity system, directly supporting cross-border payment flows. It can also sell XRP directly to institutions and jurisdictions outside the United States under existing arrangements. On top of that, there is the possibility that Ripple seeks and obtains a regulatory waiver or special approval to sell XRP to institutional buyers within the U.S. under specific conditions. That scenario has not fully played out yet, but it is a clear, logical route available to large buyers who do not want to chase thin exchange books. When you add in the existing holdings of Ripple executives, people like Chris Larson, who, along with others, still control significant quantities of XRP, it becomes obvious that not all institutional liquidity has to come from public markets. This connects directly to ongoing legislative efforts, such as versions of the so-called Clarity Act. In its current form, one of the proposed rules suggests that for a crypto asset to be truly decentralized, no single company should control more than 20% of its total supply. Ripple currently has tens of billions of XRP in escrow, and when you include non-escrow holdings and executive allocations, the total rises into the high 30 or low 40 billion range. If a rule like that were adopted and enforced, Ripple would need to drastically reduce its holdings, potentially by around 20 billion XRP. The natural question is, where would that much XRP go? The most realistic answer is that it would be absorbed by large financial entities, ETF issuers, institutional funds, banks, and other similar players. In other words, regulation that appears restrictive on the surface could end up being the mechanism that transfers huge amounts of XRP from a single company into broader institutional circulation. Now let's talk about one of the biggest potential catalysts on the horizon: Ripple obtaining a banking charter and master account access at the Federal Reserve level. Ripple has an active application with the U.S. banking authorities to establish Ripple National Trust Bank, a New York-based national trust bank. The aim of this structure is to custody reserves for RLUSD, Ripple's dollar-linked product, and to facilitate XRP-linked settlements under federal oversight. The fact that industry groups and advocacy organizations have bothered to file detailed comment letters, both in support and in opposition, shows that this is being treated as a serious application, not a publicity stunt. None of the crypto-oriented trust bank applications have crossed the finish line yet, but key regulators have started saying that digital asset firms should be evaluated under standards comparable to traditional banks. That kind of public statement increases Ripple's odds over time. If Ripple eventually secures that charter and in time gains either direct or correspondent access to a Federal Reserve master account, XRP effectively moves inside the official banking perimeter as a native settlement tool. That is a different world from where we are today. At that point, XRP would not just be a token trading on exchanges. It would be part of regulated payment infrastructure at the core of the system. Even a single development of that magnitude would be transformative for long-term perception, liquidity needs, and the baseline level of demand for XRP. On top of that, there is the story of spot XRP ETFs and how market cap multipliers work in crypto. Regulators have already signed off on spot XRP ETFs through a simplified approval regime, and multiple issuers are live or preparing to launch. One of the more visible products is from 21 Shares, scheduled to trade in the United States, with others like Canary and Ven either pre-launch or already listed at the clearinghouse level. Capital has started flowing in, with total inflows climbing into the high hundreds of millions and crossing the billion-dollar mark. Daily flows in the tens of millions are increasingly normal. Every dollar that flows into these funds has to be converted into actual XRP, which means more tokens disappearing into custodial structures. This is where market cap multipliers come into play. Crypto market caps do not respond linearly to new capital the way large liquid equity indices do. Because exchange float is relatively small, each net new dollar allocated to spot XRP or ETF products can translate into a multiple of that dollar in market cap. History has shown examples where $1 in fresh buy pressure produced $50, $100, or even more in added market cap. In extreme cases, multipliers approaching 1,000 have occurred. This cuts both ways. Outflows can drag things back down. But when supply on exchanges is already low and ETF demand is steady, the impact of each dollar flowing in becomes much more dramatic. If XRP listed on exchanges ever drops to levels like 1 billion or even 500 million units, each large inflow from institutions could lift the total market cap by tens or hundreds of billions almost overnight, simply because there is so little free-floating supply for sale. The shrinking visible supply is not hypothetical. Analytics firms tracking centralized exchange wallets have already reported that XRP balances on exchanges have fallen by roughly 40 to 45% in a relatively short window, taking available reserves to multi-year lows, even as price has mostly moved sideways in the low dollar range. At the same time, more complex products are appearing on the market. For example, index funds have been launched that track baskets of popular assets such as Bitcoin, Ethereum, XRP, Solana, and others. One such Bitwise index fund started with over $1 billion in assets under management, and XRP made up just over 5% of that basket. That allocation alone translates into tens of millions of dollars in XRP purchases. Each new product of this type, whether large or small, adds another pipeline of steady demand. Meanwhile, as banks, funds, and corporates increasingly obtain their XRP exposure through custodians and OTC channels rather than on public exchanges, a greater share of the real trading volume migrates into less transparent venues. That does not mean interest has died down. It just means fewer of those trades are visible to regular retail traders staring at charts. When OTC desks and custodial providers eventually need to top up their own reserves, they cannot print new tokens. If Ripple and other primary sources cannot meet demand at agreed terms, those desks are forced to go back into public markets because exchange books are shallow and there are no huge resting sell walls. Even relatively modest buy programs, say $5, $10, or $20 million at a time, can push price sharply higher in a very short period. Beyond direct buying pressure, there is the potential reclassification of XRP into higher regulatory tiers. While official rules rarely mention specific tokens by name, the general direction is clear. Some digital assets are progressively being recognized as eligible collateral and risk-managed positions under major international frameworks like Basel. Commodity regulators have already created pilot programs where certain digital assets can be posted as margin or collateral for derivatives. If XRP's status as a non-security becomes fully accepted across relevant agencies and jurisdictions, the same logic that now applies to assets like Bitcoin and certain stablecoins could extend to XRP. True Tier 1 or high-quality liquid asset treatment would likely arrive indirectly through regulations that permit a fraction of bank liquidity or trading books to be held in designated digital assets, and through central counterparties or central banks accepting those assets as collateral for specific types of flows. Each incremental regulatory step like this widens the circle of institutions that are not only allowed to hold XRP, but in some cases are expected to hold it as part of regular operations. All of this is happening in parallel with a broader shift in how global payments, collateral, and financial instruments are being handled. Tokenization is no longer a theory. Banks and market infrastructure providers are running active pilots for tokenized government bonds, money market funds, corporate bonds, and repo transactions. The size of these markets is enormous. Government treasuries are measured in tens of trillions of dollars. Corporate debt adds well over 100 trillion more. The repo market can process several $1 trillion worth of transactions every single day. Money market funds managed by giants like BlackRock and Franklin Templeton are already being linked to blockchain rails. Regulators in the United States and Europe have both voiced support for moving more of this activity into supervised tokenized environments. Ripple's entire value proposition fits hand in glove with this direction. The pitch is straightforward. Use XRP as a fast, efficient, neutral asset for settling cross-border payments, foreign exchange, collateral movements, and eventually derivatives margin. Foreign exchange alone is a multi-trillion-dollar per day business. If even a single-digit percentage of that flow, along with similar fractions of trade finance and derivatives, starts to move through systems linked to the XRP ledger that use XRP for liquidity and collateral, not just as a bridge for small retail remittances, the notional volumes become so large that the system cannot function smoothly at low token prices. The market would need XRP to reprice much higher simply to allow the same operations to be conducted efficiently with reasonable liquidity. This is where the so-called utility ceiling concept comes into focus. The idea that for an asset with real-world utility and a constrained float, there is a minimum price range required for it to support its role at scale. Combine that with a shrinking liquid supply, thanks to long-term custody, product lockups, on-chain fees, and more, and you have a setup where price does not drift upward slowly, but can instead leap in large increments as different layers of demand activate. Alongside these structural shifts, regulatory clarity is tightening year by year. The period from roughly 2025 through 2027 is shaping up to be an era of regulatory lock-in. Global standards for reporting, capital treatment of digital assets, and banking rules. full implementation of major frameworks like MyCA in Europe, formal licensing regimes across Asia, and clearer delineations between types of digital assets in the United States. XRP has already gained an important measure of legal clarity in the U.S. context, along with the green light for ETF structures that wrap the token for mainstream investors. As the rules harden and the playing field becomes more predictable, the largest and most conservative institutions, pension funds, major asset managers, corporate treasuries, become far more comfortable launching and holding products that incorporate XRP. That shift alone can magnify the impact of every other catalyst because it connects XRP to pools of capital that think in decades, not days. At the same time, Ripple continues to grow its own footprint. There is ongoing work on upgrades to the XRP ledger, EVM-compatible sidechains, and a steady stream of new projects that see XRP and its ecosystem as a core building block. Investments by high-profile figures in related infrastructure projects, like decentralized clearing layers that unify liquidity across exchanges and DeFi platforms, fit into a broader picture where interoperability and deep liquidity across venues matter more and more. Each of these developments adds another reason for participants to hold and use XRP, not just speculate on it. All of this brings the conversation back to one central theme: supply versus demand. Exchange balances are dropping. Long-term holders are sitting tight. Institutions are quietly accumulating through opaque channels. Regulatory and banking frameworks are slowly opening doors that could turn XRP from an optional speculative asset into a necessary part of the plumbing for payments, collateral, and settlement. ETFs, index products, and future tokenization of traditional financial instruments add constant structural demand on top of this. Under those conditions, the price that seems normal today can very quickly become a distant memory once the next phase of demand truly collides with a much smaller tradable float. As always, this is not a guarantee of any particular outcome or price level. Markets are risky, regulations can change, competing solutions can emerge, adoption can take longer than expected. Any serious approach to XRP or any asset needs to include clear thinking about position sizing, risk tolerance, and personal financial goals. But when all of these moving pieces are laid side by side, it becomes easier to understand why so many people studying these trends closely believe that the current period of relative calm will not last forever, and why they treat each day of sideways price action not as proof that nothing is happening, but as extra time to prepare before the structure of the market itself starts to look very different. Start with this key clip from Jake Claver, who tackled dark pools in a recent video. A viewer wondered if those hidden trades could run forever, keeping prices flat or barely shifting. That's a trap many fall into. They picture bottomless XRP hiding in the background. Truth is, major players hungry for large-scale buys and sells jump into dark pools, but those sources don't last. As prices rise, real utility kicks in, or rules like stablecoin regs solidify. Holders, especially big ones, lock down tight. Dark pools hit a wall against massive buy pressure. Exchanges take over, unleashing demand far beyond what we see now. That's the sideway grind on charts today. Suddenly, gaps rip higher, 2 times, 3 times, 5 times, 10 times, 12 times, 20 times easy. Retail might control just 1 to 2 billion XRP total. No match for spot ETFs, futures, and the wave building. Demand overflows to exchanges, forcing prices to levels sellers accept. XRP community, they're dug in, eyes on 3 or 4 digits minimum, strong points all around. Slight pushback on one spot. Jake frames OTC exhaustion pushing straight to exchanges, not the full picture. Ripple channels XRP through on-demand liquidity or direct to institutions outside the U.S. An SEC waiver could open U.S. doors too. Research shows it's feasible, though not active yet. Eyes peeled. Senate's Clarity Act drafts drop. Same dollar punches L.